and welcome to Coffee Chats with Klaas. Hi, I'm Kyle Kite with Klaas Financial, and today I'm here with Nate Bribey, one of our certified financial planning professionals, and today we're going to discuss Roth IRAs and see if they might make sense in your retirement planning. So Nate, most people have heard about IRAs, but today we're going to focus on what exactly a Roth IRA is and ask some questions and get some answers from you. Sound good?
Yes, sounds good.
So I know traditional IRAs have been around a long time, since the early 70s, and Roth IRAs came about 20 years later. But what was the idea behind them, and what things are special about them?
Roth IRAs were created through the Taxpayer Relief Act of 1997 as a way for individuals using after-tax dollars to save for retirement. What is unique about Roth IRAs is that contributions to them are using dollars that have already paid tax on. Therefore, contributions will not be tax deductible. But once you begin withdrawing the funds in retirement, the contributions plus the earnings will be tax-free. Every year, there is a maximum contribution that can be put into the IRAs provided you have earned income.
So what do you mean by earned income?
To contribute into any IRA, you need earned income to make the contribution. If you earn less than the maximum contribution limit, you can only contribute as much as you have earned for the year within the contribution limits. Non-working spouses can also contribute the maximum amount to a Roth IRA if the working spouse has enough earned income to cover both of the contributions and the household income does not exceed IRS limits.
So what's the max contribution allowable?
In 2021, the total amount you can put into all IRAs, traditional and Roth, is $6,000 if you're under the age of 50 and $7,000 if you're over the age of 50, which includes a catch-up contribution of $1,000. For example, you could put $1,000 into a traditional IRA and another $5,000 into a Roth IRA, but not $6,000 into both in the same year.
Many times people say they make too much money to contribute to a Roth IRA. So what are they referring to?
Well, the IRS does have income eligibility limits which change slightly year to year. Those limits depend on your tax filing status and how much modified adjusted gross income is. Some numbers: in 2021, if you're a single head of household, your contributions are allowed with income under $125,000, and those levels slowly phase out with income between $125,000 and $140,000. Married filing jointly, contributions are allowed with income under $193,000 and phased out between $198,000 and $208,000. Speak to your accountant to find out if you qualify to make a Roth IRA contribution.
So what happens when you take your money out someday from the Roth account?
Things to be aware of. You can always tap your contributions, but not your earnings on those contributions at any time, tax-free and penalty-free. Roth distributions, which are your earnings, are tax-free and penalty-free if the following conditions are met. You're at least 59 and a half, and the account has been established for 5 tax years since you first made the contribution. This is known as the 5-year rule.
So what if you need that money before 59 and a half?
Well, there are exceptions to these rules, but generally, if you're under 59 and a half years old and you take your dollars out early, you will not only pay a 10% penalty, but you will also have to pay income taxes on the distribution, which was the whole point of having the Roth IRA in the first place. So do not try this.
So what's the yearly deadline to contribute to a Roth IRA?
You can contribute to your Roth IRA until you file your taxes towards the previous year's limit, which means you can add to your Roth right up to tax filing day.
Who do you think would benefit the most from having a Roth IRA?
The benefit of a Roth IRA all depends on your current and potential future tax bracket someday as you enter retirement. If you expect your tax rate to be higher during retirement, then a Roth IRA may be the right step. Generally, Roth IRAs are often ideal savings vehicles for younger workers whose income is not yet too high and will not miss the upfront tax deduction. They can certainly benefit from decades of tax-free compounded growth.
What if I have a Roth 401k available at work? Should I consider contributing to that?
If you have an opportunity to put money into a Roth 401k through your employer, this may be a great thing because there are no income limits when contributing to Roth 401ks, whereas we do have those with Roth IRA contributions. However, you still do have a limit for the total 401k contributions every year, which in 2021 is $19,500 if you are under 50, with an additional $6,500 if you are over 50, for a total of $26,000. Another important topic might be worth considering is the opportunity for Roth conversions that you may want to consider at some point.
Great. We'll look at Roth conversions in future Klaas Chats to learn more about reasons why this might make sense in your situation. Thanks, Nate, for your insight, and thanks, listeners, for joining Coffee Chats with Klaas today.